Harish Krishnan is here with us to talk more markets and macros. Harish, afternoon. Well, we are actually meeting at a time when crude is on a massive slide, almost back to $108. That's good news. How do you see things pan out from the improvement in macros? Because other commodities were already cracking. Will the market respond?
Right, Ajay. So markets are an interplay on three broad variables. If you look top down, first is earnings, second is sentiment, and third is liquidity. And I think it's an interplay of all of these variables that drive the medium-term outlook for markets. So if I were to look at each of these three variables and how they were, say, about 8-9 months ago and how they're positioned today, as far as each of these three variables were at their peak, at the crescendo, about 9 to 12 months back. And from there on, there has been a significant change in each of these three variables. Starting first with the earnings, I think we've started seeing some kind of earnings downgrades coming through over the course of the last 3-6 months, primarily because of this elevated commodity costs that have impacted various companies. And therefore, specifically to the question that you asked of commodity prices falling off, I think it is welcome. But I would still think that, it will take a few more quarters for a lot of price increases that a lot of companies have taken to kind of get back to where they were in terms of gross margins and eventually profitability. So I think as far as the earnings cycle is concerned, there still is some more grinding down of earnings estimates that can potentially come through. But it's on the other two aspects that I think there is a lot of hue and cry and panic when it comes to macro investing, namely that of interest rates and of liquidity. So coming first to liquidity, we've seen close to about $30 billion of pullout by FIIs. Now, of course, there is still $600 billion that they have invested, and they can pull out all of that money if they want to. But I would imagine that a bulk of their selling, what they had to do, has already happened. And therefore, it's unlikely that we are going to see a pace accelerate from where it was. This can well sustain the kind of FII outflow numbers that we see on a daily basis. But I wouldn't think that we are going to see a meaningful acceleration in terms of the FII selling. And as far as the interest rates are concerned, I think we've traversed a significant distance globally as well as within India. For example, the US 10-year have gone up almost by about 250 to 75 basis points over the course of the last 12-15 months. And while there can still be further increases by under 25-50 basis points, I think bulk of that move has happened. So if you look at a confluence of all of these three things, I would say that one shouldn't really panic into this kind of a macro feature. This is possibly closer to the late cycle of the macro developments. And we would like to benefit from the volatility that markets are presenting by increasing our equity allocations. And lastly, I think the proof of the pudding is how we've managed money. So for example, in our Balanced Advantage Fund, where we can move from 20% to 80% in net equities, we were at 30% in October of 21. Currently, we are at 50%, reflecting on the improved risk reward that equities have presented themselves in this correction over the last 7-8 months.
Harish, what are your thoughts on commodity user universe? What kind of valuations are autos, auto ancillary, select capital goods, or even consumer, which use a lot of commodity, agri-commodities in their inputs and crude in their packaging and transportation?
So I would say that, if you were to look at, say, price to sales or EV to sales, that is a far better barometer across cycles rather than going down the line from a P&L into either EV, EBITDA or price to earnings. And if you were to look at a lot of auto ancillaries, especially those having global exposures, their EV to sales or price to sales are similar to a commodity company. Now, of course, there is definitely volatility in their business model. Globally, there are a lot of things that can go wrong, etc. But the reality is that I would say that the value addition that a converter brings in possibly is a far more sustainable than just a commodity producer. And therefore, I would think that value migration going from a commodity company to a whole host of these industries is very much possible. Some of these sectors that you mentioned have not performed for now almost 5 years, especially auto components. And therefore, in an environment where hopefully globally also auto starts doing well, a lot of these falls in commodity prices can potentially reflect an improved margin performance for a lot of these sectors like auto ancillary, in certain cases consumer discretionary, which in some sense can provide a faster earnings growth for these sectors.
All right, Harish, we'll let you go on that one. Thanks very much for your time today. We had a shorter chat because of so much of news flow happening, but enjoyed it nevertheless. Thank you very much for your time. Have a great day ahead. With that, it's a wrap on the show. Thanks very much for watching. Goodbye.